1 year ago, stocks were massively overvalued versus their own historical valuations, but they were cheap to bonds, unbelievably cheap to the 10-year Treasury because the 10-year Treasury yield was down at 1%. But thanks to interest rates going up and the Fed raising, interest rates 425 basis points and credit spreads on high yield bonds, corporate bonds, emerging market bonds, asset-backed securities, all widening out, you now have bonds are very cheap to stocks.
Right.
And you have tremendous income now available from a mix of bonds that say maybe pretty easy without a high risk context to get 7 or 8% from a mix of treasury bonds and some of this credit that has gone up so much in yield. And thanks to the fact that treasury yields rose, you actually have profit potential on the treasury market. It's already happened, unfortunately, to a certain extent. I mean, the 10-year treasury yield is down 70 basis points from its peak. Even the 2-year treasury yield is down 60 basis points from where it was a few months ago.
Yeah.
Obviously, taunting the Fed with their hawkish rhetoric. But the bond mix is really attractive. One thing people have to understand about bonds is it's really important what your price cost is on bonds. 1 year ago, a bond portfolio would have been at a price above 100, and you get paid back at maturity at 100 cents on the dollar. So you don't have any real enduring profit potential from a bond portfolio purchased at or above 100 cents. But thanks to the interest rate increases, bond portfolios are down in the 80s or even in the 70s
Wow.
in parts of the credit market.
Right.
And it's very easy for bonds priced at 75 to go up to 85 or 95. That sounds like the profit potential from the stock market.
It's huge.
It's a good case.
Jeff,
And yet you have 4 times the income flow and less downside. So bonds are really cheap compared to stocks. And going back nearly 25 years, every single Fed move has been presaged by an earlier move in the 2-year Treasury. Just think about a year ago when the 2-year Treasury was up at around 1.5 around the Super Bowl last year, and the Fed was dragging their feet on raising rates. And lo and behold, they had to do 4.75s in a row to catch up with the 2-year. But now the 2-year yield has been falling, and the 2-year yield is below the Fed funds rate. In fact, every bond yield in the Treasury market is below the Fed funds rate. And right now, the 2-year Treasury is at 4.13, and the high end of the Fed funds rate is 4.50. So I think if the 2-year Treasury drops below 4%, and it could happen any day now with the way it's moving. I mean, It's moved already 30 basis points year to date. So we're already 3/4 of the way to that sort of below 4%. I think you're going to see a radical shift in Fed rhetoric, because the 2-year Treasury is always, people should really look at this overlay chart. I have it on the webcast.
Okay.
That's going to be up on replay, the Just Markets webcast. It's remarkable how you don't really need the Fed and their 800 PhD economists. All you need is a Bloomberg terminal or a screen, and look at the 2-year Treasury. Plus, there's so many recession indicators that are now flagging. The leading economic indicators is always very important. It's very negative. It's more negative on a 3-month annualized basis than it is over year over year. It's negative 7.3 annualized. You've got money supply growth. M2 is non-existent over the past 12 months. You've got ISM orders, ISM PMIs that are tanking. You've got the housing market, which obviously is very slow. So the Fed just needs to get in line with the bond. I will give Powell some credit. I think his framework is that if you have inflation that really takes hold, the ultimate consequence of entrenched inflation and elevated inflation expectations leading to a really intractable problem might be worse than a moderate recession. And I think that's his framework that he's thinking of. But yes, raising the interest rates is going to cause pain. He said so. But he doesn't want the long-term inflation problem. I really think he should stop worrying so much about the inflation problem at this point, though.
Right.
Because inflation's coming down, and it's going to come down further for sure in the next few months. It was at 9.1, now it's at 6.5, and I think it's going down maybe into the high 3s by the middle of this year. The question really is what happens beyond that. Basically, the Fed is going to be incrementally easier than other central banks, just as they were incrementally tougher during 2022, and that's why the dollar went up quite a lot for the first several months of the year. But now they're over tightened, I think, and they're going to be easing, and the dollar is going to go down. And that creates a tailwind for dollar-based investors in foreign markets. And the US market outperformed by a humongous amount over the past 10 years prior to 2022 and became very overvalued versus its own historical valuations and very overvalued on things like Dr. Schiller's CAPE ratio, really more than double the valuation of emerging markets, for example.
Right. So with emerging markets then, is it you just buy maybe an ETF? Are there parts of the world, for instance, China with the reopening, that might actually even exceed the general growth of emerging markets?
I really just like a broad basket of emerging markets. Typically, I don't like China because as a U.S. Investor, the tensions between the U.S. and China keep escalating. And I worry that if something really goes bad, you might not be able to get your money out. So I worry about that. But I do think China, the reopening will be incrementally positive. So for the short term, I would not be afraid of China. But I think South America, I think India, and Southeast Asia primarily, though. India is my number one pick long term.
Yeah.
I just think demographically, India is exactly where China was 35 years ago. And we've seen what happened to the relative economy of China versus the United States. And I think India is going to be in that same position, and they have fantastic demographics. So I would buy that one and hold on to it. I wouldn't even open my statement for 5 years, lest you get fearful when it drops 25% in a quarter, because I think this is a long-term, this is an investment for your grandchildren's college education. When it comes to commodities, I look at the Bloomberg Commodity Index, BCOM, and it's been living below its 200-day moving average for a while now after going up quite substantially in the first few months of 2022. And I am not involved really in commodities other than gold at this point, which I also think will do well when the dollar goes down. But with the economy weakening, it's difficult for commodities to really get going on the upside. I really think you need easier monetary policy for that to happen. So I'd wait for the BCOM to cross above its 200-day moving average and stay there for like a week or something like that. And then I would think you might see another leg up in commodities as the dollar declines. But now I'm on the sideline broadly on the commodity complex. And just look at WTI, which is a really important commodity. And that's been going, it's been hanging out there at about 80 for quite some time. So I want to see that start to move on the upside as well.
I want to pick up on the gold for a minute because gold's acting great. The chart looks phenomenal. Last year, the central banks that weren't the Federal Reserve, maybe not the ECB, but all these other global central banks bought as much gold as possible. Is there something, what's going on that's sparking this particular move?
Well, I just think it's global uncertainty and also the dollar going down again. I mean, the dollar's been really important relative to the gold price. So in most currencies last year, gold did quite well because it was pretty stable. It was up 2% in dollar terms, but the dollar index was up a lot. So in foreign currencies, you did pretty well in gold. But I just think that sort of mistrust of the geopolitical situation will likely also be a tailwind for gold in addition to easier Fed policy and declining dollar.